Let's talk about where you should be buying stocks right now with Randall Eley. Randall, options? You got clients who would, or plain vanilla stock ownership, or do they want no stock ownership these days?
Yeah, most of our clients will want just basic stock ownership. Let me just mention, I think it's important for everyone who is trying to invest long term, which I think is the best way to do it, to understand that what is going on is the Federal Reserve is removing the biggest punch bowl by 4 in American history. And when that happens, you're going to have some unintended consequences, such as the banking crisis we're going through right now. But the United States is going to survive this. I feel that very strongly. We've got the assets. And volatility, when it comes to securities, particularly investment grade, whether it's stocks or bonds, is part of the price we have to pay. Long-term investors will continue investing in stocks in particular that are valued correctly, meaning not overvalued, and that have strong balance sheets, don't have a lot of debt. And this is something, Kelly, you will remember I've talked about for a long time. And so in this market, we're seeing the value of that. So
I love the reassurance, Randall, except for the fact that you need to give it. Usually when we get to the point of, the country can survive, we don't really want to be there. We've talked in the past about stocks like AT&T that you like. I don't know if you'd want to kind of weigh in on that one. In general, Randall, people right now are looking at yields and saying, well, wait a minute. I've seen First Republic cut its dividend. I've seen Intel cut its dividend. I'm probably forgetting some others. How do you sort through the names out there and confidently pick both a yield, if people want that in this environment, a stock that you can own for a while and not be exposed to that dividend cut risk? That's right.
You've got to separate between those that have strong financial positions first. Intel, as far as we can see, is their earnings are not what we like, but it's still a strong company financially, wherein when you get to, these regional banks that are cutting dividends, it's for a different reason. So Intel's management needs to, they need to get more efficient in the way they're running the operation and show us what they can do with the great amount of assets they have. But we need to stay away from companies that are paying dividends out of a dwindling supply of money, and therefore the company go out of business. But so I gave you 3 names, I think will meet that test.
Yes, and I'll sort of steal your punchline. You like Exelon, the utility, General Dynamics, you like Pfizer, but even names like Disney and Starbucks, if I'm not mistaken, have seen dividends under pressure. No one thinks those companies are going away, but I wonder if that tells us that when they have to prioritize growth or reinvestment or expensive streaming or what have you, that, these things aren't always Teflon.
That's right. We're going to leave the running of the individual companies to the management, but it's a fact of life. In a market like this, where so many companies are now struggling to get access to finances, they're suddenly realizing that they can't borrow the kind of money they could even a year ago. The Fed is pulling back. So in this kind of market, the companies that have husbanded their capital, they can find other opportunities in being able to provide that capital, whether it's in distress situations or whether it's just growing their business now in a lower cost way for them.
All right, Randall, really great to have you here today. Thanks for sharing your wisdom. We appreciate it. Randall Eley with Edgar Lomax.